So last time I talked about transactional lending. Now I'm going to talk about relationship lending. And remember, transactional lending is essentially going online, looking and seeing what the rates are, calling someone up like a fintech, a Rocket, or something like that, and say, "Hey, what's your rate? I'm looking to buy a house. Can you send me a fee sheet?" You get a fee sheet with your rate, all the fees. I call it two-dimensional. But everybody is so different in their financial and just mentally about what they're wanting to do with mortgage. So you have to ask more questions. So when someone reaches out to me, I ask a lot of questions and I present them with options that maybe they didn't even know they had, and enlighten them as to what certain price points might mean, what certain rates might mean to them, and more importantly, what the total cost of the loan is going to be over a certain amount of time. So let me show you what I'm talking about. One of the first things I do is when someone is asking about the rate, I'll go in and I'll look at a lender who is probably my go-to, has the most competitive rates, and like comparing it to what bank rate was offering, they were offering 6.5 with 1.5 points. Now, I've been in the business long enough to know that that number is probably going to be very underestimated. I like to overestimate. I'd much rather my clients come to the table with less money than they were expecting at closing and with a better rate than I quoted them, as opposed to the other way around. And I'd mentioned about and I'll show you that slide again, but they had a cost of the loan over 8 years, but they weren't using all the fees in there. Well, if you're going to be making such a huge transaction, you need to know what all the fees are. So here it says 6.5 is costing 2.5 points, which just because I know this lender, bank rates, that's not realistic number of what they're quoting. Can look at it as a starting point at best, bait and switch at worst. So then what I'll do, because I'm a broker, I'm not stuck with just one lender as I would with a bank, is I can go shop around and see, where the rates are with everyone else. So I'll go in and put in the same parameters that bank rate had. And I just came up with this. This was real time. This interest rate, that's going to be about 1.5 to 2 points, 6.5. So that's in the ballpark. And now what I'll do is I'll produce some options for a borrower and explain the pluses and minuses of each. And that's going to look like this. This is 0 points, 1 point, and 2 points. No escrow, because the bank rate example that I gave did not have point or have escrow. And escrow, just as a reminder, is just your taxes and insurance. So at 0 points, the rate is 7.625. 1 point, 7.125, 2 points, 6.5. The 2 points, this is really the apples to apples comparison of what bank rate was offering. Their APR was 6.686. This is pretty close APR, but again, I'm putting in all the fees bank rate didn't. And the points, 1 point is 1% of the loan amount. So 1 point here is 2,842, and then 2 points is 5,683. This is an escrow, so the P&I, principal and interest payment, is the payment, which I highlighted here, and then total cash to close. That's down payment and closing costs. And you see, as you with the increase in points is the increase in closing costs. And essentially, that's the difference between the point here and the 2 points there. 80,000, 83,000, 86,000. But let's look and see what it would look like if you actually threw an escrow, because a lot of people want to escrow. They want to know that the taxes and insurance are getting paid. My guidelines are usually, I'll tell a first-time home buyer, they're normally not bringing 20% to the table, so they're going to have to do the escrow their taxes. So it's a good way to get used to it. But then if you have a couple of homes, 2 or 3 homes, and you have a credit score over 700, that implies that you're a good steward of your money and you could really pay your taxes on your own, taxes and insurance on your own. save yourself in closing costs. Now, that's not to say that people just sleep better at night knowing that it's getting paid. But if you've done it a couple times and you trust yourself to make those payments on your own, you can have that money sitting in the bank, earning for you instead of the bank. Or really, you're being taught by the bank to teach you the discipline of paying your taxes and insurance. Well, you don't have to do that. And what I did was, this is escrow, and you'll see the difference in the monthly expenses here. The taxes I used was $373, and the insurance was $104 a month. That's monthly. So you see the monthly payments higher, and the closing costs are higher by about $6,000. The reason why, I'm sorry, the difference is about $2,000 or $3,000, but there's $6,000 more than the no escrow, or almost 7,000. Okay, and as I mentioned, what you want to know is what's the cost of the loan over a certain period of time. The bank rate example, 8-year cost was $145,519, but again, they are not putting all the fees in there. So this is a very low estimate, but I did do it for 8 years to give an apples to apples. And you see it's almost $162,000 over 8 years. And that's the 2-point option. The 0-point option, you'll see the cost is higher, a difference of $20,000. But what you want to also know is, what principal and interest over 8 years, what are you going to be paying? And so this little chart shows the difference between a 0, 1, and 2 points. Again, the over 8-year period, the total amount paid in principal and interest is lower than it would be if you did the 0 points. So at this point, a borrower might say, all right, well, then it makes sense to pay 2 points, because in 8 years, that's going to be the lowest total principal and interest payment. But you're paying points. So what's the break even? Like at what point are you going to start making money from the savings of paying the points? And this is very simple. As I mentioned, 1 point is 1% of the loan amount. The difference in payment is here, and then the break even in months. So the difference between no points and 1 point is just over 2 years, and the difference between no points and 2 points is just under 3 years. But this is a huge but. All the pundits and I'm not talking television pundits, I'm talking like people who are on TV, but they don't host TV. They spend their time watching the market, watching mortgage-backed securities. They're saying that the interest rates are going to drop within 6 to 18 months. So if the interest rates are going to drop and there's a refinance opportunity, then that eight years, if you're going to stay 8 years, it makes sense to do the 2 points. But more than likely, you're going to be refinancing, and instead of paying for the points, if you're going to be refinancing in 2 years or less, 18 months or less, why not use that to roll those costs into your refinance? And here's what it looks like, the total cost of the loan after 2 years. Now you see it's really only a $780 difference between 0 points and 2 points as far as cost. And if you're saving yourself $2,800 or $5,600, then this is going to be the right option for you, again, because within 2 years you're going to be refinancing. That's real time. This is what I would be telling someone today looking for a loan. And then you look at 2 years, the total paid principal and interest, they're essentially the same too. So if the rates were going to keep going up for 8 years or stay the same for 8 years, then you buy the points. But more than likely, you're going to be refinancing in 2 years, and it makes more sense not to pay the points. So what does that mean? It means, you don't pay points to get the lowest interest rate, because you're going to be refinancing within 2 years. And that money's out the window. That's a sunk cost. So just as a review of all the things I've talked about over this triumvirate of videos. Rates come from the same place, well, Wall Street, mortgage-backed securities. So whether you're a bank, correspondent lender, or broker, you're going to have rates that should be no more than a 0.5% of each other. And as a broker, because we have more flexibility, you can expect that on average, you're going to be paying 2 to 3% for in lending fees, closer to 3% if you're a bank, closer to 2% if you're a broker. And while it's a good start to go online just to kind of get a feel for where they are, you really need to talk to a mortgage professional. Obviously, I would love the business, but you may have your own person, and you should be asking them the questions that may have been stirred up by watching this video and the previous two. There are 30 different factors that determine interest rate. So what is your rate is a very vague question. As I mentioned in part one, most people just want to know that you're going to give them a competitive rate, take care of them, and put them in the best situation. I talked about the 3 types of lending institutions: the bank, the correspondent lender, and the broker. Strength and weaknesses, and obviously brokers are really taking over in market share because we have the flexibility in interest rates, and we're in such a high interest rate market, higher than it's been ever since I've been in business in the early 2000s. And you also want to know the total cost of the transaction relative to what your goals are. Whether you're going to be in, and like most people are at least in their house 4 to 7 years, and in their mortgage 4 to 7 years, but those two aren't the same. You can be in the house 30 years and refinance 3 or 4 times. So those are the kind of questions I ask, and those are the kind of questions you should be asking, or information you should be giving to the mortgage advisor that you're talking to. Is, like how long you see yourself in the house, and there's life events that happen that cause you to need to refinance, whether it's debt consolidation, or you want to build onto the house, or maybe you want to move down or size up. Those are all important facts in structuring your mortgage for the time that you're looking to buy. And then the break-even analysis for the rate. If you're going to buy down the rate, what's the break-even? You want to make sure you're going to be in that mortgage at least past the break-even point, so that you're seeing some benefit from having paid the points. And as I just said before, today in general, it's not worth paying the points for a lower rate. Unless you need a lower rate to qualify if you have a high debt to income ratio. But that's another conversation that I have about the comfort level with your debt to income and your monthly payment. So if you have any questions or want me to do an analysis for you, you can always reach out to me. This is how you contact me. Please follow me on social media, like, share, and subscribe to my YouTube channel. That would be awesome. I'd really appreciate it if you got something out of it. That's it. Have a fantastic day.